All right, so we're watching price this morning, first trading day of the year. I went short on two fair value gaps and one at the top of the orange fair value gap at 38.60. Looking for a continuation down into the levels I shared on Twitter. Initially, I thought that we would get 39.20 as a run up, aggressive run, as a Judas swing, like a fake rally aggressive during the PMI numbers at 9:45. The market was not having that. So that's why I said we have to wait and see what the market does. It failed to run above the 39.05 level. So I waited for the shift in market structure at just below 38.72 and 3/4, 73, and then return back into a fair value gap. You can see the entries on the left-hand side on that 1-minute chart. Broke down, traded to get another short entry into the fair value gap and also bearish order block. And the third entry is at the top of the orange fair value gap at 38.60 as it traded up into that, looking for heaviness going down into the 38.39 level. So I took one partial, leaving two contracts on, and I want to get below that 38.42.50 level. That's where sell side is. You can see that noted on the right-hand side on a 30-minute chart. Now, why am I using a 30-minute chart? I want to see price remain below that fair value gap here on the left-hand side. If it goes above that, then I'll probably have to want to close the trade. That's what I'm thinking, but I want to see it remain heavy. Heavy means I want to see it go lower and have difficulty rallying higher. And if we trade down below 38.42.50, I will take one off, but rejecting that 39.20 level, like I was expecting, that daily volume imbalance up there, right-hand side chart, that upper orange level, that to me was a likelihood of a draw on the news driver. Okay, but I'll take another partial off here. And we'll see if it wants to go down and take that. I made a low-hanging fruit objective now. And we'll see if we get that. Boom.
All right, so this morning, like I said in the tweet, I'm neutral, so I don't have a bias yet because we've already swept Friday's high. We traded down into the hourly fair value gap I gave you in yesterday's commentary before market open for the new week. And whenever there's an issue with two sides of the market where you can anticipate certain things, like I was watching this fair value gap up here and seeing does it have the willingness to get down through this fair value gap, through this gap to attack the sell side. And if it were to do that, I would expect it to go there. So while I'm not in a trade because I'm neutral, my mind is watching price action and trying to get a read or measurement on order flow. I don't need depth of market. I don't need, DOMs, ladders, all that stuff on the right side of my chart. I'm reading order flow from what price is telling me in the candlesticks. So if I see that there's a conflicting signal, like this could be viewed as a long and trade back and through, as I mentioned, if we go above the fair value gap, that negates any bearishness. That gives me a sentiment reading. Whereas right now, looking at the chart, it rewards me for not wanting to be in a trade, but it also gives me insight. So I'm watching now, do we get above this fair value gap? And if it does, then I'll be looking for more clues in price to see if it continues and wants to rate into that 40-30 level.
All right, so I'm going to force myself a trade here off the fair value gap off a bullish order block. I'm going to aim for Tuesday's high in a condition that I already know is pretty shitty anyway. So in normal conditions, I shouldn't be stopped out here. And this is going to hopefully put an exclamation point on the Twitter space I did last night where we talk about the unlikelihood of high probability. So I like what it's doing here. I want to see it trade above 40.26. I'm annotating Tuesday's high, which if I'm correct, if this were a bullish scenario that's going to lead to a higher run, I want to have a best case scenario, which is taking out Tuesday's high. But I'm going to be taking a partial off and moving my stop to break even once I can get off at 40.28 and 3/4, where it says buy side. That's the next near term draw. Sell side was taken out with a drop down below 40.20 down into the 40.15 and 3/4 level. And I'm going to be looking to take off one contract here and then take another one off at the next pool of liquidity made at the 8:30 high. And then the balance would be used to a run, preferably to Tuesday's high. Really, really unfavorable trade conditions, but I'm forcing myself to engage that way. You can see there's a difference between trading in high probability and this shit. I'm just waiting for that candle to reach above the buy side. Okay, taking one off there. Then I'm going to roll the stop to break even because it's a shit day and it can come back and stop me out. And you'll see it will do that anyway. Okay, so buy side's been purged. And I'm getting ready to annotate the volume imbalance and then shit the bed and stop me out. So there's your example of why I don't trade on days like this. Good morning, folks. It's Monday morning. It's presently about almost 10 minutes after 8 o'clock Eastern Time in the States. Your trading view chart should always be set to New York time. That way you can follow along in everything I'm referring to. Here's the closing price on Friday. And I want you to take a notation on that. Draw a little line out from it. And note that we also have a gap lower here on Sunday's trading. We started trading there at the open, traded down initially, and then came all the way back up and closed in that gap from the close of Friday and the opening on Sunday. So that is our new week opening gap. So you want to have that noted on your chart like that. Okay, and with this, I want to pull out from this perspective. And right now your chart should be default on, that's electronic trading hours. You want to click on that and go to regular trading hours. Okay, if you click on that, you'll see that all those other candles disappear. So here's that same area here and here on the 15 respectively on the lower, hourly up here. So if I maximize the 15-minute time frame chart, you can see there's where we were and then where we delivered. Okay, and that's why I'm waiting specifically for the 9:30 opening and range to see what we do. But whenever we have a gap like this, it's more likely that it wants to try to draw up in and revisit, because fair value on the daily chart, not fair value gap, but fair value is last Friday's close. So we've got down here, if, like for instance, say hypothetically we're trading at 40.50 at 9:30. That means there's a large gap between 84 and 50, difference between Friday's closing price and where we open up on new trading in regular trading session hours. So it's more likely that the market will want to gravitate towards that direction. It doesn't necessarily need to come all the way back up to that gap, but it sets the tone for a soft bias. Okay, when I say soft bias, it means I have nothing to lean on except for that's the minimum expectation right now. All right, so I couldn't get the recording to start soon enough. We have a volume imbalance, bullish breaker. We're inside of a 5-minute fair value gap. So I'm going to buy, if it can touch the bottom end down here, I'm going to buy that. I'll go in with 8 contracts. This right here, I'll explain to you if I can get the fill. Right now I'm more focused on that because it could run away without me. Likely to trade up into 40.57 1/4 and then 40.59 1/4. So I'm watching. Come on, give me the low end of that fair value gap. Just touch that bottom orange level. Just touch it again. That's all I'm asking you to do. And I'll do the rest. Come on. Just a little bit more. Don't run yet. Come on. Drop down there and touch that lower orange level. There you go. Thank you. And we will put a stop loss below the volume imbalance, which we've already traded to. Right here. I was trying to be live in the recording as I hit that and go long there, but it's okay. Now we have this breaker, which is low, high, lower, low. Split that range in half. What do I mean by that? From here to here. 53 1/4 is permissible. So I can take my stop loss if we take this high out. The short-term high has to be broken. Then I can raise my stop to the bottom of the breaker here, which will still be below mean threshold, which is 53 1/4. See that red level right here? That's half of that. So even though it can come into this range, I don't want to see it go below that level right there. Okay. So you write that. That's permissible. There's nothing wrong with that. In fact, I'll add to it there just to prove that it's okay. Now I want to see price repel from that breaker and aggressively go through this high and leave the 5-minute fair value gap, which I'll show you in a second here. Bear with me. So these two orange levels here they are anchored on this right here. So that candle's low, that candle's high. So we drop back down to a 1 minute chart. So my core position is 40.54 even. It's got to trade to 40.59, and I like to have a quarter point more to cover fees and commissions. So it would be 40.59 and a quarter. That's what I'm looking for. So that would be 5 handles on the morning session using the opening range and gap protocol. That we have a lower gap opening for 9:30. So we'll see what we get in regards to that panning out or not panning out. Basing around the order block, this is 1, 2, 3, 4 candles down. Market should not go below this low. We went to a volume imbalance, which is here. Relative to this low, that high, we went to equilibrium to discount. We should expand up. I want to see large candles expand up into 40.57 and a quarter, reaching up into that 3 o'clock in the morning fair value gap I told you on Twitter to annotate, which is up here. That shaded area. I sent that on the Twitter. All right, see how we had this little gap here? Price will want to come back down and fill that in. That is a real liquidity void right there. Right there, that's a liquidity void. And I will buy more if it trades into it. I'm not so interested in seeing it now. I can, but I want to see it now, specifically aimed for that 59 and a quarter level and ultimately reach up into 61.50. I'm going to try to leave 2 on for that price, 41.61 and a half. Remember the levels here, that's that 5-minute fair value gap. We're above it now. So they tend to act as what? If the narrative is correct and it's bullish and we're above a fair value gap, they'll act as you would expect. Classic support and resistance that hardly ever works. This is what you're going to be looking for support. So notice we have several factors here. We have this high and this low from the 5-minute fair value gap. So midpoint of that is consequent encroachment, which also has a volume. I'm sorry, not a volume. It has a real liquidity void, a gap, an actual gap. There's no wicks at all here. Let me take that off for a second so you can see. There's no price at all here between this close and this open. Also, we have this down close candle prior to what? The displacement above the short-term high. So you have a bullish order block. So you have several things here that are constructive for another buying opportunity. So watch that level there. And if you can hit it, I can do another long pyramid, hit this and fill in that little liquidity void right there, which will be basically the upper portion of this order block here. So mean threshold would and should be respected there. But there wouldn't be anything wrong essentially with touching the lower end of that fair value gap on the 5-minute chart as well. So here we go. Come on, just a little spike down in that little gap there. Boom, there you go. Thank you very much. Thank you very, very much. Now you can go higher. Stop, it's still down here. You want to see large ranges run right up into 40.59 and a quarter. And then I can do my moves like Jagger. Remember I mentioned how we could touch the bottom end of that fair value gap on the 5-minute chart. We got that here. Look at the reaction. Now I'm doing all this over one chart. There's not, just because I have a lot of monitors doesn't mean I'm monitoring multiple positions and doing it both directions. It takes a whole lot of energy and focus to just do this. And while I think I'm above average, that would be above my pay grade. I can't focus on that many things moving. So we're going to be doing, let's see, we got 14 contracts. Let's take 5 off. If we can hit the 40, 59 and a quarter level. So that would give us 5 handles for the morning with using the 5-minute fair value gap I used as a draw on liquidity made public on the Twitter feed. Just about 30 seconds or so from the opening. Mean threshold, remember that 54 level down here? It's all part of stop management. 15 seconds opening. Everybody wants to sell short. Excuse me. And they're going to get their faces ripped off here. And launch higher. Rip it up there. Fair value's up here. Come to daddy. Come to daddy. Oh, this is so fun. Remember I said we can go down to what? Mean threshold here. And it's exactly where we went to. Beautiful. Beautiful. Yes, 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 yes. And I think I just went negative on. Yeah, I did one contract over. That's okay. And there's the business. Good morning, folks. It is Tuesday, the last day of January. Already, the month has gone like that. I tweeted this morning the consequent encouragement of the daily chart here up in the left-hand corner. Let's maximize that chart. So if you look at the candle right here, this is January 25th of 2023. And I've measured the close to low consequent encroachment is 3997.75. That's this level right here. Okay, so the blue dotted line, that's what I have annotated on the lower time frame charts as we progress down. And then this level here is the order block, bearish order block. So we've come up and bumped into this, bumped up into that daily bearish order block. The order of retracement that we've seen here is all hinging on what I'm looking at is this as a point of interest, something that we could potentially trade to today. It could avoid it entirely. Before the market trades in the opening in New York session, I'm looking for reasons to justify why the market should draw to a specific point of liquidity or inefficiency. We trade down a consequent encroachment of this gap here up into a premium array on the daily chart. Even though this is a hourly chart, this level is the 26th of January's low. We're going to go down to a 15, so you can see that level down here. So while this is a point of interest for me this morning, if we trade above the bearish order block relative to the 26th low, I'm absolutely neutral on the morning, and I would have to wait for more information. And it allows you not to push, not to rush, not to force a trade. Just because we have a level that we're interested in or that I make mention of, we have to wait for time of day. And time of day is crucial. And everything changes technically if levels are not respected going into those starting time points. More specifically, 8:30 in the morning and 9:30 respectively for the stock index futures. So sit on your hands. There's nothing to do. All right, so I tried to get this recorded, but I couldn't make it to the office fast enough to start the recording. Opened the trade up on my phone using the order block here. Actually trading on the premise that it's a market maker buy model and sending price up into the new week opening gap, which is what I mentioned this morning on Twitter. So that might be viewed as a breaker, that shaded area here. It's not a breaker. It's just a speed bump. It's going to go through that. Most traders that would be trading, quote unquote, my ripoff edition of Smart Money Concepts, they would see that as a sell. It's not. So it's going to be drawn to this buy side liquidity here. And there's an order block right there. I will add notating this draw on liquidity. So my mind is thinking it's going to draw up to that level there. We're digging down into that down close candle. Going to highlight it and then add. And I can trade down to the midpoint of that, which is mean threshold right there. That's good. That's not a problem. I don't have obsessive compulsive disorder. It won't let me leave that trend line the way it is. All right, so let's run on over here, add 5 more contracts. And it's going to want to vault quickly to take out the high of the day that's noted here where the buy side liquidity is. I'm going to lighten this up. It's a little too dark. All right, so I want to see expansion, a lot of speed. Good stop to break even. So I already know I'm on side now. On side means I'm right. Well, let me rephrase that. I'm most likely right. And it should be aggressively trading to the buy side and then up into that new week opening gap, that shaded like orange level. If you're not following along on Twitter, it isn't going to make much sense to you why it should be doing this, but I commented on this morning. Okay, the most recent down close candle. Watch that high of that candle to its open. That'll be a very sensitive price point. I'm not going to add any more to the position though. I tried to upload this in a very short version, like the 2-minute stinger videos, to Twitter, and it wouldn't let me do it, not even without having any music attached to it like I usually do. But oh, I'm sure some of you are going to be like, oh, I like this better. So you can see how we reacted off that order block, as I mentioned moments ago. Now we just ripped into the buy side liquidity, which is wonderful. Everything's going to plan. So I want to see it draw up into 4076.75. That's the low end of the new week opening gap. What that is it's the gap opening on Sunday's trading. So wherever we opened up from Friday's close, the difference between the opening price, the very first tick on Sunday evening, that's the new week opening gap. Okay, I want to see it expand up in to that shaded area. I'll draw it down somewhere you can see it. Now we've tapped into buy side liquidity, so it could pull back a little bit. There's a small little fair value gap just formed if this candle closes. Okay, so the fair value gap right to the left of us now, 2 candles back. What I'm measuring here is consequent encroachment. I'm going to take 80% of the position off, which will be 20 contracts. All my attention is here, not elsewhere. Okay, and if it gets to 80% off there, my thought process is it'll try to go to the top end of the opening on a new week, that gap, to the high end of that shaded orange area. But for right now, my mind is focused on it getting to the bottom of it where it says draw on liquidity. If you look at the high that was formed approximately at 320, that short-term high was broken to the upside, and I bought inside the first down close candle as it was going down. I'm buying into that. I'm annotating it as an order block. It later touched it again. I didn't add anything there though. I'll show you the executions momentarily. Within striking distance of that new week opening gap, again, understanding narrative prevents you from falling victim to pretending you understand what my PD arrays are, because otherwise, in the hands of a neophyte or a fraud that just tries to sell my stuff with the labels and such, in hindsight, picked, cherry picking things that I don't do. Here we are, hitting the new week opening gap. So it could pull back into that fair value gap just below the buy side liquidity pool. I would want to see it support that if it drops down into that, and I want to see an immediate rejection of that and then go higher. There we are. So I would want to see it snap higher. But not knowing what the narrative is and how to really use the concepts I've authored, one would look at this shaded pink area and assume that was probably a bearish breaker. No. And I'll go long in that. You have to know what you're doing, folks. Otherwise, you hurt yourself. And if you're trying to pretend to be a guru with my things, you're actually harming people through ignorance. I know it sounds like I'm trying to prevent other people from making a name for themselves, but none of you are there yet. So now, since we hit the bottom of that new opening week gap, my focus is here, which is consequent encroachment, which is the midpoint of a gap. Any inefficiency, the midpoint of that is consequent encroachment. It's always abbreviated as capital C, period, capital E, period, in my charts and annotations. There we go. So we're looking for off that fair value gap. Now it should be a lot of momentum and spring out of there. Big caffeinated candle right there. Yes, indeed. Thank you very much. I'm just waiting to peel off 20 contracts as soon as we touch that consequent encroachment level. It's really fun to be on these types of trades. And there we are. So I'll roll the stop up, lock in 2,000. Okay. And now I have the lines portion of the move already put down. So what I'm watching is, do we find some support without leaving that lower quarter of the consequent encroachment to the low of that shaded area? I want to see it reaccumulate and start expand higher. Now my stop is admittedly very close, but I don't care. Because at this point, tomorrow's FOMC, it can do anything it wants to do here. It can get reckless. It can just keep on going. So it makes no sense for me to let it come all the way back down into that blue shaded fair value gap and lower. So that's why I have my stop there. If it takes me out, I'm happy. I'm fine. But now my focus is I want to get to the top of that new week opening gap, which is the shaded area. So I'll start peeling off singles. This has already been done, so I'm going to change the annotation to 80 has been taken off here. And I'll drop my contract selection down to 1 contract, and I'll start peeling them off. As we dig into the upper half of that new week opening gap. So what I'm doing is I'm watching. See those relative equal highs that's formed right now on the right chart, at the 1 minute chart. I'm going to wait and see as soon as it prints another candle just above that, I'm going to take one off. This is called running down equity. Every time you're in a trade and you have the ability to take partials, and it's a move that's been delivering for a little while now. This is a little bit of a long-winded run here. So I don't want to spend too much time holding on the bulk of my remainders. So I got 5 contracts. I'm going to start peeling them off. As soon as that candle starts to print right above those relative equal highs I have noted now, as soon as it prints just above it, 1 tick, immediately one contract's going to come off. Here's one of those real bull flags. I'm looking away from the monitor right now. I'm realizing I missed the opportunity to do it, so I have to wait. I looked at it and I was like, oh, what the cuss. But I'm confident it's going to run up to the top end of that new week opening gap. So you sit here and you just wait. Now, when I'm going to watch and see when it makes a higher high, then it's already printed there on that candle. And as soon as it does, then I'll peel off 1. I'll sell 1 at market of the 5 I have on remaining. There you go. And I'm going to be watching halfway between where it is now and the top of that shaded area. Approximately, my eye is looking for it to reach up into that. And when it does, I'll take another one off. I just peeled 1 off there. So 3 contracts remaining, and just a little bit more. I'm looking for it to pop up about. Now, as a new trader, this is going to be nerve-wracking for you because you're afraid it's going to, okay, I'm going to peel off there, and then at the top of the range, and now I'll want to roll the stop on that final balance, and if it takes me out, I'm okay with it. This is a beautiful price run. Absolutely gorgeous. And there's the stop. So I'll show you the executions. You can see they're not on a market replay. Hope you found it insightful. Until next time, be safe.